head set on. Let's untangle that. And what we need to do at the same time here.
All right.
There we go.
Very good.
All set.
Good afternoon. It's really a pleasure to be here. Just a little background, when I started with wycoff from the floor, a friend of mine got me on the floor, and I was a runner who ran out orders to the pit, which is you don't see anymore. That's everything electronic. And I noticed in the order flow that went into the markets and how that happened. That's how I discovered wycoff. But let me just back up a little bit and say that, everything happens for a reason, for fate, whatever it is. And around 15 years ago when I first started, I looked around and I saw who does price and volume. I discovered wycoff. Then I came across, I Googled and I got a Tom Williams. And he sent me some information. And I said, darn it. And my wife said, what's wrong? And I said, I've been trying to program this thing for a very long period of time. And the software person said, can't be done. And I said, okay. So I left it go, and I went by hand, and I did my own work. And obviously, the product now came out, and for the last several months, I've been watching Gavin's work, which is phenomenal as far as leading markets-wise. But what I do is more of a pure wycoff type of thing, and I do more of a wycoff that is maybe the terminology maybe a little bit different than your VSA would do, but it's all based on the same principle. So, as I said, when I started 15 years ago on the floor, I realized that there was an order flow to it. And I realized there was different price and volume at different orders. There would be 300 contracts of the D-Mark, which you don't trade anymore. And there was, various different volumes. So I went to the Merck Library, Chicago Mercantile Exchange Library, and I saw something called sales by price. And it had every volume and every price of every trade that happened, that cleared. And I made a histogram. I made volume on the bottom with price, and I wanted to see vertical bars of where there were volume and there wasn't volume. So I'd see 1,000 contracts here, 20 contracts here, 20 contracts here, 20 contracts here, and 1,000. And I didn't know anything about technical analysis at the time. But I knew that if there was volume at 79 in the D-Mark and there was volume at 71 in the D-Mark, that those two areas would develop some type of range that they would buy it. So I knew that there was big interest that would buy at one price, and they sell another one. So I went to a couple of Ford traders, and I said, look, if the market's at 75, if you buy it at 71 and sell it at 79, you'll make money. I had no idea what I was doing, and it worked. Then I discovered wycoff price and volume. So that's a little background. Then I worked for a couple of brokers, and I got my seat on the floor of the exchange. I went to the exchange in 81, got my seat, was sponsored for it. 89, I left the floor when computer trading started to take off a little bit more. So they said, Gary, go see the market from upstairs versus seeing it from the pit. I was on the floor in 87 crash, and I got some stories about that I could relate to you guys, maybe tomorrow if we have time, because we're pressed today. Having said that, there is, if I say something that's maybe a little bit different than what you may be used to, it really is part of the whole wycoff world, but it just may be coming from a different angle. In wycoff, there's no indicators. There's only two live indicators to wycoff. Anybody know what they are? Correct. They said price and volume. It's the only two. The rest of the indicators you see, for lack of better terms, are BS to a degree. Do they work? They do work. Do they fail? They do fail. But wycoff wanted to be more than a guessing game. He wanted to be more than, I think it may work, I think it may not work. So the only thing that you could look at is every indicator is in hindsight. Your RSI, your ADX, your MAX. They do work and people do follow them. The pits use, or the big traders use 200-day moving averages. They do all these things. And they work basically by self-fulfilling prophecy. Because they say, oh, we're above it, let's buy it. Oh, we're under it, let's sell it. But they're really hindsight indicators. And I can't stress to you that the only thing you need in wycoff is price and volume. Wycoff did not have a computer. Wycoff didn't invent anything. All Wycoff did was he talked to the great traders of his day, J.P. Morgan, the world, who comes up a lot, you know. These people still exist. And Keene, you can look all these people up. And all he did, Rockefeller, all he did was say, what are you guys doing? What makes, and money talks. And he interviewed Gann and all these people to get what they did. So what he did was he said, you know what? News is all in the markets. And the composite operator, I call him the composite man, but the more correct term is composite operator. All he did was he accumulated a position and he had distribution of a position. And he would watch the movement of what they did, the whole process of what went on. But they knew, the news that they knew, you talked about, you know, the news on making lows on bearish news and things of that nature. Well, it's all the psychology of markets. As the markets go higher and higher, what happens to the markets? People get more and more bullish. When the markets go low and lower, people get more bearish. It's the way the market is. The difference between the composite operator and funds and SPACs is the composite man takes the risk and buys the support in the up market, takes the risk and sells resistance in the down market. Funds and speculators say, buy that breakout, sell that breakout. So they're almost doing the opposite of what smart money does. You know, one thing you went back, we talked about Goldman Sachs stock, and someone gave you a gift at the time. Well, if you remember when Goldman Sachs rallied, and I think maybe Tom Williams, I don't know exactly when it was, but during the time he bought it, if you remember that Warren Buffett announced he was buying the stock, he came out, which was kind of strange, but it wasn't for a particular reason, but obviously. So it also shows you that strong money moves the markets. And everything is based on price and volume, and everything that goes on is something that you just have to identify where you are in a particular trend and how markets work. And it's not that difficult to understand markets. It's very difficult to trade markets. There's a reason why 90% of people lose money. So you have to understand. You know, as Gavin said also, is that, and everyone said that wycoff works in 5-minute intervals. It works in yearly intervals. Okay? And we'll go over why the difference between those things. But I can put up a chart here and not tell you the time frame, and it doesn't matter. It doesn't matter what time frame it is. The only difference is how far the move can sustain itself. And we're going to talk about that today. Volume is relative to the price that it trades in. In other words, let's supposing I'm trading grains in the summertime. Would you expect the volume up or down generally in grains? Higher, because you got growing season, you got nature. In December, the volume tends to be lighter. Not so much more today because you have Brazil and those countries today. The point of the matter is that you cannot compare July corn volume in the middle of a drought to December. All the volume is relative to the area. And tomorrow and part of today, I'll show you how to, and Mr. Weiss will tell you as well how to make money from the sense of how to do setups. Not make money, but how the proper wycoff setups are. So, when we also talk about manipulation, let me just say brief about this. You said that all markets are manipulated some way. That doesn't mean it's done illegally, okay? I don't know if you know the process of how markets work, and I was telling when I was in the pit, and you talk about it a little bit today with the gold and silver, if a composite, if a person, a big interest, wants to accumulate a position, he can't buy, the market's at 30, he can't buy 31, 32, 30, he can't buy the rally, because you know what the whole pit does? Buy at 34, buy at 35, they front run them. So what they do is, in the pit, when they did it at the time, is that they would give a broker a contract of 25 contracts. And they give 25 contracts to about 10 different brokers around the pit. Different brokers. And they'd buy themselves 250 contracts. They'd have another broker sell 2,000. He didn't want to sell one contract. But in order for the market, for him to buy the position and buy a couple lots here and there, by offering the markets down, the 2,000 contracts down, guess what the pit does? They want to get in front of a big order because they lean against that order and they push it down. And this is what the composite man, the whole system works. They talk about that in the metals. That's how they get price. Smart money does not buy rallies. Smart money supports and buys supports in uptrends. They sell resistance. They do not chase markets. Once they have their line of accumulation, the news and the public take it higher. News to wycoff is in the market by price and volume. It's there. Let me go a little bit about, getting ahead of myself. Let me go through this 2 goals, 3 laws, and 5 steps, and let me go through that, okay? One of the most important things, is that obviously one of the first goals is to make money in trading. And one of the things the most important thing to do is trading, as I said to you, is one of the hardest things you'll ever do in your entire life. It is hard to make money. As I said, 90% of people lose money. But, having said that, if I'm going to risk money and it'd be a high-risk venture, I have to make it, in a sense, to be profitability back to me. If I'm going to put that big a risk, I have to make it worthwhile to do that. It's very difficult to do, but you know what? By using price and volume, I think it's the most proper tool you have. The second one, which doesn't get talked about enough, is preservation of capital. And it sounds easy. Oh, don't lose your money. When you first start out trading, you have a little money and you have no knowledge. As you get knowledge, you lose some money because there's a bridge between them. The adage on the floor used to be, if you could survive 1 year, and most businesses are the same way, if you could survive 1 year in this business and basically break even, you have a good chance of making this business. Having said that, I know hundreds of traders on the floor. I would say most traders that I know that made money probably lost it all before they made it. It's just your learning curve. Trading is a business, and you have to treat it as a business. And if you treat it as like a Vegas, I tell people all the time, the difference between trading and Vegas is that I don't serve you drinks. In trading, it is so difficult in trading to be proper all the time that you could never let down your guard. And you have to treat this as a business, otherwise don't trade. And sometimes your business does well in one day, 1 quarter, and sometimes it does poorly. But it's a marathon and not a sprint to what you do. And you must treat it like so. This is why I think the education part that VSA and they'll do, their webinars, the things they do, is so nice education-wise because they're taking your learning curve that we all went through and trying to make it where it's more palatable in trading. So the pain that I went through and Mr. Weiss went through, we went through, trying to speed up that learning curve to hopefully do better in trading. When you first put on a trade and you prepare for your particular trade, once you put the trade on, the rest of it's very easy. All required is monitoring the trade. We could all trade wycoff here, but trade it differently. Okay? But once you put the particular trade on, something that I like to do from the floor, they kept telling me, was they should put 100 D-marks on, these guys. And they look at me and say, Gary, what do you think? And I was like, what do you think? I mean, I was scared. It's, a lot of money per tick. It's $1,200 a tick. And they would say, I would say, I think we're right. You know what they did? They immediately got out. I said, why'd you get out? Because you think we're right, and I think we may not be right. When I said to them, it's a good trade, they held the position on. The point is, when you put a trade on, you know immediately if you're right or wrong the trade. It's up here that fights it. So ask yourself, if I wasn't in this trade, would I be in the trade? If the answer is yes, keep the trade on. If the answer is, I'm not so sure, get out. That's preservation of capital to a degree. If you think you're wrong, get out. Nobody ever lost their account because they paid commissions. They lost it because they didn't follow the rules instead of things they did. When you're in doubt of the market, and it may even work out for you, and you got out of the market and it worked, doesn't matter. It doesn't matter. If you think you're wrong the trade on the time frame that you are in and the parameters you put the trade on, you must be out of the trade. It doesn't matter. It doesn't matter. Trading with stops. Wycoff used the thing called a disaster stop. And what that means basically is I like to play stops. If I'm trading a 5-minute chart, I cannot put my stop underneath a 5-minute support level. Because I'll bet you everybody here that trades has gotten jabbed out a tick or two under the low. People say, well, how do you know where the stops are at? It's logical. I was in the pit. Easy to know where the stops are at. People are lazy. They put their stops at even numbers, and they put their stops right underneath the previous low by 1 or 2 ticks. For a floor trader, what he does is, if they probe down there, he buys that knowing that those are weak hands, and guess what happens? He ducks around to get out of them. So if you're on a 5-minute chart, put your stop on a 10-minute basis, 15-minute basis. Put it away that you don't get into a spring position in an up thrust position. Put your stop on a larger time frame. You may lose a little bit more money, but when you get stopped out of a market, you want to get stopped out because you're wrong the position, not because the market had a little hiccup to it. So I believe that placing your stop a little further away will prevent you from getting jabbed out. But remember, I said to you, if you think you're wrong, get out of it. What Wycoff did was so masterful was when he thought he was wrong, he got out of the position. So stops should rarely get hit. Because if you're monitoring the position and you think you're wrong, then that stop that's on a different time frame shouldn't be hit. You should be out. It's very important about stop placements. I would see it all the time. Preservation of capital, again. You're trading poorly. You have 2 or 3 losers in a row. You're down money. Yesterday's trade doesn't mean nothing. A salesman that's no is closer to a yes. In trading, if you do the proper trades and you're going on a losing streak, do you know how you prevent that? Not prevent it, because you can't prevent losses. What you do is you never cut down the stop loss placement that I talked about. You cut down your size. If you're a 5-lot trader, guess what? You go to a 2-lot. Do not let equity in an account affect where you place your stops. It's very important. If you can't afford to make the trade, then do an option, do an ETF, do an E-mini, do a spread, do something that you can participate in the move if you're right. But you cannot afford not to make the proper trade. We talked about that screen earlier. You must take that trade. In an uptrend, you must take that trade. Okay? And I can't stress as much. Cut down on your size. Do not cut down on the equity stop. Because the market doesn't give a rat's butt where you place your stop. But if you place the stop improperly because of money, guess what? They'll get you 100 times, every time. It's like the silver market. We talked about the stops this morning, where they're going to get you. If you can't play the game, stay out of the game or go to a different contract. But you must get to a situation in which you cannot let equity dictate to you a proper trade. There's talk about, you probably heard about, a trade should be 3-to-1 risk-to-reward ratio. Okay? I'm sure you probably heard of that. To me, it doesn't exist. If I get a trade that can make me $200 and I'm going to risk myself $80, under 3-to-1, I have to take the trade. If it fits my parameter and fits my niche, I must take the trade. It's all part of preservation of capital. You must take the trade that's right. It's vitally important. And if you can't trade because of equity, then you have to do a different parameter, but you must take the trade. Otherwise, it doesn't work. Gavin talked about 3 laws, okay? And this is the heart of wycoff, so I'm done. Read this, and you know this, and that's it. Effort versus result. What is it? It's a very, and I'll do some charts, we'll go over this stuff, but effort versus result means the result is how far a market can go. The effort is price. The result, the effort is the volume, and the result is how far a market can go. Okay? I take back. I apologize. The effort, the result is obviously where the market can go. Okay? The effort is the volume that pushes it. Okay? So in other words, let's suppose you got a stock that's going up $10 over a period of time on a million shares. Okay? The next day, use Yao Mi example, the market now does 50 million shares, and it goes up $6. There's a great effort, and the result is less. That's effort versus result. Theories. This is results. So the effort is push it up. The result is what you get out of it. We talk about the shorting of the bars. We talk about wide bars, large volume. We'll talk about that, with charts. But it's the effort versus results that is very important. If they're out of link and they're out of whack with each other, okay, you can't be done. In the packet today, I gave a definition of the glossaries of all the wycoff terms, knowing that a lot of people don't know wycoff. So that will be helpful with everything. Cause versus effect. Basically, the longer the market goes sideways through a trading range, and markets are probably in trading ranges 70-80% of the time, the larger the effect of the market will be. So we talked about a 5-minute chart that wycoff can do, and we talked about a monthly chart. If I trade a monthly chart, and it's been going side, and I'll show you examples tomorrow, the cause is huge on a monthly chart. It could go, the Dow can go from 10,000 to 20,000 based upon the cause. If I'm on a 5-minute chart and I buy the Swiss franc at 76, can I expect that market to go 500 points higher? I can't. On a 5-minute chart, it can't be done wycoff-wise because the cause of the market is not there. The cause has got to be commensurate to the effect. A smaller time frame gives a small result. This is where people lose a lot of money because they take a 5-minute buy signal. The market does what they're supposed to do, makes their 10 tips, and they don't get out. And guess what the market does? Comes back down. The market did exactly why you put the trade on a 5-minute cause. To wycoff, you have to be in a situation with wycoff that it's done by point and figure chart, which we'll go over in a minute. But you cannot expect a 5-minute chart to give you cause of a monthly chart. It's against the law. It's against the wycoff principle and law. It can't be done. Now, can that 5-minute chart turn to a 10-minute chart, to an hourly chart, and give you more cause? It can. But if you base a trade on a 5-minute chart, guess what? You have to liquidate on a 5-minute chart. If you don't, you run the risk of losing money. And then again, we'll show examples of this because wording is difficult sometimes. So you got effortless result, the volume and the price movement, if they're not in unison with each other, the cause and effect, and the last one is demand and supply. It's simply wide bar, demand and buyers. Who's winning the battle? The buyers or the sellers? Who's winning? There's a battle every day that happens. It happens the high, the low, and the close. When you close out at the end of the day, and you get your P&L statement, profit and loss statement, one thing matters on your P&L statement. You know what it is? The close. That separates the bulls from the bears. That told you who won that battle. You want to use wycoff as telling a story. Is demand winning the story? Is supply winning the story? Who is winning that battle? We tell it by the volume, we tell it by the length of bar, and we tell it by the close. Demand and supply, and there's just buying and selling, which are a little bit different in a sense, but demand and supply tell you the power behind it. Who's winning the battle? And that's a question you should ask yourselves every time you trade. Who's winning the battle? What is the story telling me? Because wycoff is very much of a trend-following system. We're long until we see a change of behavior. I think Gab was talking about markets where selling comes on up bars, and I told you that the composite man will sell resistance and buy support. That's where that comes from. Okay, the fact that SPACs and funds buy rallies, they don't sell rallies. When it gets too frothy, they're stopping the action on the other side. So you always are constantly checking demand and supply. Okay? There's 5 steps to wycoff trading, which I want to go over them. The last 2 are important, but they're kind of combined. But let me go over the first one, and a couple people have discussed it before, and this is very, very important. The most important, I'm going to say it twice, it's that important. The most important piece of information you have in the market is what? Trend. The most important piece of the information is trend. Why? If you're in an uptrend and you buy every support, and you're basing on a daily chart, let's say, and you're buying every support on the daily chart and placing your stop underneath the weekly supports, as long as the daily trend is up, how do you lose money? You go through drawdowns. My point is, the most people that lose money in this business, in my opinion, they lose the money because they don't follow the trend. I'm a trader, okay? I want to be a buyer. 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 Oh, you know what? Let's sell it up here. I missed the whole buy. I'm mad at myself. What do? I'm going to sell a top. Doesn't work. Why? Because wycoff talks about retest, and we'll go over this stuff. So if you miss the top, you're going to get a subsequent retest. If you don't get it, the market doesn't do it, you know what? There's another trend on board. You must follow trend. It's the most important piece of information that you can have in trading. If one of those three laws get broken, cause and effect, effort as result, demand and supply gets broken, then you can look to counter the trade. We were talking about, when the market, Gavin said he would not take that short trade, and that when Mr. Williams would sell it, and Gavin said I'd wait for the market to retest before he take the sell. That's the more proper trade, and it's more of a primary type of setup for wycoff. Okay? So we want to look for a retest. If we miss it, you know what? We miss it. As I said to you before, that most markets stay within trading ranges. This is where the most money is lost. And I think you all understand what a trading range is. It has a resistance, and it has a support, and it plays within a sideways range. The worst possible way to make a trade is in those trading ranges, because you don't know the outcome of that trading range. Your level of knowledge in the market is very low in the trading range. So you need to wait for demand or supply, and I'll show you examples how the trade's set up. But your level of knowledge at that point is very, very, very poor as far as that goes. But a market will stay in a trading range most of the time. So in your trading, you may have a trading range in a 5-minute chart, or you can have a trading range in a daily chart, but in a 60-minute chart could be something completely different. You have to trade the trend of the market that you're trading in. If you're trading a 5-minute chart, trade a 5-minute chart. Okay? It's very important. And the trend is the most important thing. What determines trend? Trend is simply a successive lows that connect each other. Any child can do it. What the better way to draw these lines are is the greater the reaction, the better the line, because you want the buying as support. And I'll show you examples today and tomorrow. The greater the reaction, the better the line. Wycoff very rarely used trend lines per se, sloping ones. He used, and I'll show you in a minute, parallel lines that show overbought, oversold, and show trend lines. And I'll tell you why, the danger of drawing trend lines. I can have all you people draw a trend line from 2 points, and if you're off by a 1/4 inch on your chart by the way you draw it, one person will say, "Oh, you broke the trend line." One person says, "No, you didn't get there yet." Wycoff talks about areas. That's how composite men deal. They buy areas. They don't buy 1 point. So because it breaks it by 1 tick and my trend line is off, guess what? I have a losing trade. Doesn't work. Wycoff used horizontal lines, and we'll go over that. So again, trend is the most, if I can stress to you, the most important thing is preservation capital and trend are the 2 most important information you have. Okay? One of the things, also another thing is there's a lot written here, for you, and due to time and stuff like that, I'm not going to be able to go into a lot of things that I want to go into. We have another half hour or so. But again, there's 4 types of trends. There's a short term, there's a very short term. There's more of a, like an intraday. There's a short term, intermediate, long term. The longer the time frame that you trade, the more likely success that you'll probably have in trading. That does not mean you can't trade a 5-minute and a 15-minute chart successfully every day. I know a lot of people that do. But because of the factor in noise, you get a news item that comes out at 10 o'clock in the morning, and you're basically a 5-minute chart, that thing, the slippage of that, the noise of the day could hurt you. So the longer the time frame is, the better for your trend will be. And if you're following trend, you obviously don't want to get shaken out of your particular trend. Wycoff talked about, and Dr. Gary talked about as well, about strengths and weaknesses. And tomorrow I'll show you some great examples of the S&P, the Dow, and the NASDAQ markets that all differentiate because of the dot-com in 2000. And I'll show you why they decoupled the strongest and the weakest ones as far as that goes. It's a very, very important thing. The most important thing to do in trading is to follow your trend. I can't stress it more than that. I think most of the money is lost in this business by not following trend. If you miss the trade, you miss the trade, folks. That's the way it is, okay? One of the things, there's two ways to know how far a market will go. Two ways. One is by reverse trend lines, which you see up here in a trend channel. And two, by point and figure charts. How many people know what point and figure chart are? How many use them? Very few. Why? It's very hard to do. And you have to have box size reversals, but we'll talk about that in a minute. When I do charts for my class, my trading room, I take current charts. And the reason I do this is because I can show you classical charts for the 1950s, 1960s, 1970s. It's not going to help you make any money. So I try to draw current charts that tell you a story that you can make money from, okay? This particular chart here, there's a lag of time, and it's important, is the S&P 500 chart, okay? And it probably ties into a lot of VSA, and Gavin could probably run a scan and do it. This is the S&P from 2009, the bottom, okay? The composite operator talks to each other all day long through price and volume. Tomorrow I'll show you about 9/11 chart. I'll show everyone but Gavin the chart, but for tomorrow. But I'll show you. He'll get no sneak previews. But anyway, if you look at this particular chart, and you don't know where the market's going to bottom. You know, when Gary was talking about, Dr. Gary was talking about the chart earlier, and he had a secondary test. In reality, you don't know the secondary test will test everything. You don't know if it's going to retest under the selling climax or before it. You never know. But you got to watch price volume. And that's probably where, something where VSA will help you a lot because it'll probably tell you the turn as the market's heading back up versus the test. As we draw trend lines, we know that March of 2009, we made some type of low. We don't know what that low is. We have no idea. Something unique about the stock market that not a lot of people know or very novice people don't know is that the stock market it tends to make bottoms as a V bottom. They don't tend to, they do have their selling climaxes, but they have a selling climax and they immediately run. And people say, I'll wait for a secondary test to buy, and they never get one. If you remember in November, everything was very, very bearish, and then made the low. And they made the low, obviously, on the most bearish news. And this March, I think, was Bear Stearns, was March of 09. Very bearish news. Whatever it was. But they made it on very bearish news. This is the up was lows. Something, Gavin kind of used the terminology earlier today. What do you notice about the lows at the bottom there? That you're Yao Ming. Remember I told you the volume is relative to the area? Does it stand out significantly? Maybe not to a person that's first tried with Wycoff, but to me, do you see how that volume is doing this? You see how the volume is increasing as you go into the bottom? The bottom of that market was decent volume. If you look at the next volume, the volume was very high. What was the range of the day? People say sometimes it was a reversal type of thing.
Yeah, you can actually point to it. There's someone.
Okay.
Could you use the mouse and just point to what you're talking about?
Fantastic.
There you go.
You see this little right here? That's not right. Okay. Let me go back there. You see the little right here? The volume is this. You see the volume? It's increasing. What's the next bar? Increased volume, increased bar. Okay? Effort versus result. More volume, more range. That was a very significant bar. Okay? Now, I lied to you in a sense because I told you that you need cost to sustain a move. Okay? This one, we talk about cause usually. We talk about a sideways action. This one didn't have your cause sideways that we normally typically would have it. Okay, so I kind of lied to you in a sense. Not lied to you, but this is a little different type of chart. But I'll tell you what has fooled people. Everybody was negative this chart. Nobody was positive. The composite operator knew everybody wanted to sell it. They couldn't wait to sell that market because you just came out of a 2-year bear market, a year-and-a-half bear market. Could not wait to sell that market. So what he did was, instead of having a retest so those little shorts can get out, guess what he did? Guess what he made you do? He made you buy it higher. Okay? Now, look at the volume in that rally. This volume here. Is it lighter or heavier than this? It's lighter, correct? You'll say, Gary, that's lack of demand. We got to retest. Right? And I remember in class doing this, following through, because we were long up to around, we had a target between 12 even and 12.10, and I'll show you, the difference of why we turned around with the point figure charts in the market today. That lack of volume after demand is bullish. Only after demand is it bullish. If this doesn't happen, okay, this is very bad in distribution going lower. If you're in a downtrend, you either go lower and find lack of supply, but in order to change the trend of a downtrend, you need one important aspect. Do you know what that is? Demand. If you do not get demand from a downtrend, you cannot go higher. You cannot go higher. Because what is a downtrend telling you? A downtrend tells you that sellers are winning. Once demand comes in, the game's over. It's called the change of behavior. This particular volume, high volume, is what we call in wycoff volume off the bottom. Okay? A little more advanced beginning-wise, but it's called VOB, volume off the bottom. In this whole market higher that we went, grinded out, remember, they're forcing people to buy. So what happens is, I come in the morning, I sell the market. End of the day, if you look at those closes, they're mostly higher end. People that are short saying, oh, no, let me get out. They buy end of the day, look at the closes. Closes are high end. Who's winning the battle? The bulls. They try selling it, come back up. You've seen this in action all the time, right? Mark comes down early in the morning, breaks, and reality closing the high. VSA, wycoff, everybody else says demand comes from lower. This is what it is. Starting out lower, high-end close. Who won the battle? Bulls or bears? Bulls. Win the battle. Look at the break that you've had here. What can you say about the character of the break? Do you see, if I told you that on the downside, you need demand to go back up, if the market's going back up, the opposite is true, correct? You need supply. Is this supply here? Do you see an increase in volume here? No. Wycoff never used retracements, like the 62% and all those nature. What Wycoff found halfway back from a move was an area that he liked to be long from or short from. So halfway back corrections, Wycoff used as a guide. In this channel, It's about halfway back. Okay? Once I saw this line here, I knew that I had to wait for a secondary line. If I would have drawn that line here, my trend line here, that slope of that line would have been too steep. We do not want to draw steep trend lines. We like them ideally about 45% of an angle. If we draw this too quickly, this trend line will be broken and everything else. So Wycoff rarely used sloping trend lines to begin with, but he always used the parallel channel of the trend. And you see this right here? This is called a reverse trend line. It's an overbought condition. If the market goes above this position, you cannot, Wycoff teaches us, you cannot be long. Though the trend is up, you cannot be long in an overbought position. Let the market come back down, give you a sign. You're bullish, and you talk about, what someone asked earlier about, where you get long. It's a danger area to be long in an overbought situation. Where to place the trade. You can't do it. Okay? Now you see this hovering that goes on here? You can say, well, Gary, if I'm long, you take profits up here or you raise your stop. That's how you trade this market. And an uptrending market, it's very important, will go higher until you get supply. So, market goes higher, but look right here. Look at these days here. You see this here, these two like volume days? You all see them? It corresponds to a high. This, I'm sure, with VSA is called a lack of demand. Correct. I mean, I think it's pretty obvious to everybody here today. Means not the trend is changing, but you know what? We're going to correct. Because we know that we have a short-term possible trend of behavior, this correction point will be our point 2. Because and look at how beautiful a sloping line it is. Okay? Now I take those 2 points and I immediately draw my reverse trend line. Look how perfect that is. This is live. These are real. This is not 10 years ago. This is right now. I don't do charts back then. I told you. You see how in that channel, if you're long, did you lose money? It's impossible to lose money. You never make a lower low, and you're always making a higher high. Okay? In my newsletter, I had a target about 12 even to 12.10 based on point and figure charts. I was talking to Dr. Gary, he was saying he's at 12.05. I mean, Wycoff eyes are Wycoff eyes. I'm sure the VSA has some of these all wells too because it should formulate to them. But I want to show you something very important about this particular chart, about this chart. Look at the top bars. These 1, 2, 3 bars here, right here. Okay, this is May, right? This is that. I think not the Thursday. It could be that Thursday. Monday was that first break. Okay, okay. You see the volume increasing here. You see this here? Effort versus result, correct? Increased volume. What's my range saying? What's my ranges here? They're small. I call that, in my terminology, stuffing. Effort versus result is not there. Wycoff law cannot be changed. It is what it is. When I see volume and price action not kosher, when I don't see it doing something with higher increased volume, I would expect increased bar length. So that tells you funds and specs are buying it. Why? New high. Who's supplying them the market? Strong hands. They're keeping the range tight so all those buyers are not being rewarded. 3, 4 bars. Increased volume, sold, sold, sold. The composite man did not have to mark that price up. The people, he just contained the range. Why did he contain the range? Because if he allowed the market to rally big time up, guess they would have done? He would have to fight more people being long because the funds would have bought it. So he decided to keep it in a very small range, but they gave you the clue of that bar. It's obvious, and this is recent, and we'll go current charts too. Effort versus result. That's a change of behavior that happens. It happens also in here. You see in here? See the increase in volume? Look what happened here. They gave you that selling down. Okay? So when you see one of those three laws change, run like the plague. Run like the plague. The next chart, okay? This is the dollar index, correct? Same chart to the downtrend, okay? We know this has been going down for a long time. We easily can draw our trend line going down and everything else. What do you notice about this? About here? When you have a supply area, what should happen in a downtrend? Selling. If it's a supply line, it's called the supply line, the wycoff, by the way. If the market is bearish at resistance, guess what happens? People sell. What did the market do with these? What's the market do? The market, though in a downtrend, don't forget, the composite man doesn't trade hour by hour per se. He accumulates a position. Okay? He bought, usually you see absorption, we talk about absorption, this is more a version of it. By hovering the supply line, there's a lack of sellers here. You see that, how it's hovering that line? Lack of sellers. Now, what I tell you about a market that's in a downtrend, what needs to prove itself to go up? You need demand, correct? Look at what happens here. High volume, breaking the trend line. You all see that? It's a wonderful chart. It's telling you that if you go back to this volume here, high volume, what was the range? Very tight, right? It's telling you, that's how the CM talks to each other. It's saying, hey baby, the volume is big, somebody's holding the market up. This high volume should have broken the market down. What did it do? Small range. Effort versus result. Okay? But that's not enough to turn the market up, to wycoff. You need demand in the market. You must have demand in the market. Do you get that demand? Yeah, of course you do. This was the market was at 75. I think the market's at 83 the dollar, 85. But the point is, though, is that remember I told you about when it doesn't seem right, you think to yourself, does it act right? Does it act right? If I'm short the dollar at resistance and I'm not making money, guess what? I better get out. Okay? I'm going kind of quickly today because of time. Of this. Point figure charts. Again, one of the backbones to wycoff. You cannot pardon me. As I told you with reverse trend lines, overbought, oversold is when you need to either get out, take profit, or you need to tighten your stop. In a point and figure chart, this is part of the newsletter that I do, that we send out to clients, you see a series of X's and O's there. X's are the up bars, the O's are the down bars, in case you've never seen this chart before. And you take a box size and you take a parameter of a reversal box. I don't know if it's a point figure, but and I don't have time to go into it today. But you take a certain box size of the market and what it will take to reverse the box size, and then you start the other column. So X is on the up, O's on the bottom, on the downside. wycoff used these things but there's no, you see two things aren't out here, volume and time. It doesn't exist in point figure charting. Some people mark it from their own, but it's not part of it. The importance of it, of horizontal lines. The longer you go sideways, cause, the bigger the vertical move happens. Result. Cause, result. Okay? Before I knew point figure charting, what I did was, it's funny in my class, when I did my class 15 years ago, I took my thumb and my forefinger, I did this. And I went like this. And then, oh, Gary, you got great point figure charts. And my thumb. My thumb was too fat that day, I was off. But that's how I taught people to do it, in the sense of, it's a guesstimate. Point figure chart is the opposite of charting in a sense of you go from right to left. You take the cause sideways, you count the boxes, you see the green? You count the boxes. The more that the horizontal trading range is, the larger your count. You can take different counts. There's minimum, maximum counts to wycoff. Okay, you see that example, okay? Go through a little quicker. You see, this is, by the way, this is the current S&Ps as of last week. Okay? Yeah, I don't know if you probably see the right, it's tough to see, but it's a great chart. It tells you the difference of sideways of what goes on, and it tells you, you see the different green bars? It tells you just a different cause that happens from each level. See, each sideways action gives you the vertical up. Okay? Tomorrow we'll do all this as examples as far as where to look for trades and things of that nature, okay? But that's important. Another point I want to chart to you is this. This chart, if you look on the bottom of this chart, was done Sunday, May 2nd, when I started preparing for the seminar. What's unique about that particular day? It's a Sunday, the 2nd. This was before the Thursday meltdown. Obviously, no one knew about the Thursday meltdown on Sunday. But if you read the notes, and this was done by one of the people in my class, and they might talk about point and figure chart. It talks about the NASDAQ market. And it talks about, you see the sideways action of this particular chart? You see what's happening? Okay? That's cause. It could be on a bar chart, but it's a cause. You see the blue X is up and the O is down? That's all cause. Sideways move will give you a vertical thing. Okay? So we know that's the case. Do you see the horizontal line? It's taking cause between the two things. It gives you a minimum count to the downside. Now, this is before we knew the market on Thursday was going to happen. Okay? Next bar here. You see how the line, a horizontal line, continues to go further across to the left? Look at the cause now, extending down. Okay? This is the NASDAQ. So we were able, through charting, and able to look at the markets, and I mean, it could be upside cause too, don't get me wrong. But we were able to see that the market was kind of going through an area of distribution on top of the market. So we did a point figure chart saying where the NASDAQ market can go. Again, this is on Sunday before the Tuesday. So it's pretty, apropos that these charts have to be done well in advance of that Thursday. Just notice how the horizontal line goes over and across. It goes more across. The larger the move from the right to the left, the larger the move down. Now, I know a lot of people, it's kind of dry, and I know it's kind of point figure charting, and maybe you don't do it and probably say, you know what, not a big deal. But the wycoff, in your studies of wycoff, point figure charting is the only way to know when your cause is being used. It's a guesstimate. It's not rocket science. It's only a guess but it's a pretty good guess. When you place a trade and you want to get out on a daily chart, you generally get out and says, oh, you know what, that's resistance, get me out. But that's improper because you're getting out in an area that you probably should stay long in, and the market may hold resistance, go sideways, absorb, and go higher. The only way you know in Wyckoff's world how far a market can go is by a point figure chart. Only way. And by reverse trend lines telling you overbought, oversold is the way to get out of. People may calculate how to get out and find out where objectives are many times, okay? But to Wyckoff, it's not correct as far as his cause and how he counted things. You may say on a 5-minute chart, it usually gives you 15 ticks. You get out 15 ticks. That may cause you stuff. But the way to measure it more accurately than a guess is that way. Okay? You notice a little further down, you notice how it goes from right to left, go further, okay? I mean, we go over this stuff at my website as far as that goes. So, it's overwhelming, I know, and it's kind of dry, but it's something that's important as Wyckoff students, if you're studying Wyckoff, what it is. I know Gavin's mentioned to me about his doing point figure charts more so for VSA because it's so part of Wyckoff-wise. And 99% of people that don't do it, why? Because it's too hard. Not hard, but it's tedious. It takes time to do it. Okay? Wyckoff, many people don't follow Wyckoff because, I got to follow price and volume. Just give me a black box, the 900 number, to tell me buy and selling it. That's why I don't mind telling you about Wyckoff, because most people here that listen to Wyckoff will never follow Wyckoff. Will never follow it because they won't put the work into doing it. But the only indicators I told you that are real time are price and volume. So if you're not following real time, that's the best tool that you have in trading is information in front of you. If I get information that happened 3 weeks ago, I can't make money off of that. But if I watch the market real time, I can judge what's happening in the market. Okay? In step 5, that goes on in 4 and 5 together, we talk about a stock, the readiness to move. When you, and I'll show you examples tomorrow again, lack of time. When a market is in a trading range going sideways, it starts that trading range. After we talked about the selling climax, how the market goes like this, and then makes a rally, makes a secondary test. After that market does that secondary test, it tends to form a trading range. But after you get volatility in the market will go into a trading range to build cause. This is what you're probably seeing right now in the stock market, by the way. The low of 1060, the high of 1075 recently, 1175, you will probably form many, many weeks of a sideways trading range. People, we're going higher, we're going lower. This is called the left side of the trading range. After the volatility, you do this. It goes wide range, and then goes this, and a smaller range, and volatility decreases. Once you get to the right side of this trading range is where we look for trades. And I will show you with charts tomorrow, and we'll do the S&Ps tomorrow, and we'll do Boeing stock tomorrow. And I'll show you what I talk about today to tie it in how to look for trades. And Mr. Weiss talks about how to look for trades too. So when they talk about the readiness of a stock to do, if you're buying or selling the S&Ps now for a position, it's more of this range-wise, okay? You're going to be caught in a lot of volatility. So if the market is not ready to move out of this particular range, yes, you can trade it and have the volatility, but the market is not going to move out of this trading range, the stock market, for a little while, in my opinion. Because you're going through some type of that selling low of 1060 and the resistance at 1175, which we'll discuss tomorrow again. It's not a tease, it's just that the charts for tomorrow are designed that way. So you want to place a trade in your account when the stock or commodity is about to move. How are those features at? Well, one of those features is a spring, a retest of a spring in an uptrend, an upthrust and a retest of an upthrust in a downtrend. And Mr. Weiss will go over that as well too. Those are what's unique about a spring? In a spring in an uptrend, as I talked about, as I interrupted the statement before, always should be bought. The purpose of a spring is to take out stops, sell stops, and to get the funds short. When you have a spring market, an uptrend, and we showed that chart earlier, always in an uptrending market, a spring will be successful for you because it's not breaking support. You buy springs and uptrends. What happens you buy a spring in a downtrend? What happens? Springs fail in downtrends because the market's making lower lows. So unless you're a very good trader quick, you do not want to buy a spring in a downtrend unless you're scalping the market out. Okay? It's a danger, again, going with trend. So in wycoff terms, when you see that spring, and I'll show you examples again, when you see that spring, if you're not afraid of how deep that spring will go because you want to put a stop loss order, wait for a retest of that spring, okay? That low of the retest should not take out the original spring. Place your stop a little bit away from the spring in uptrend, and you probably have a good chance of having a successful trade. In an uptrend, springs are a very proper way to trade. Okay? We talked about, so those are places to look for a trade, okay? Another proper trade for wycoff is, we talked about in an uptrend, the jump over the creek, the sideways trading range, and a retest back of that creek. And again, I'll show you examples of that tomorrow. So,
5 minutes.
Okay? So I'm going this kind of quickly, and I apologize for that, but because of lack of time, I told you. But again, you look for trades on the right side of a trading range because that's when you're going to get your jump over the particular creek or you're breaking the ice support. Okay? That's when you get your particular best trades. Okay? Or buying a spring in an uptrend with the appropriate stops. Going against the trend has cost people most of their money. Go with the trends. If you miss the low or you miss the high, you're gonna most likely get some type of retest in the market. If you don't, you miss the trade. It's irrelevant. Okay? It's very much irrelevant to what happens, okay? You do not want to be, I'll go back to this for 1 second. You do not want to be, you want to follow the particular trend of this particular market because look what it gave you. Even though recently we took out this channel line, so they got you out here. You put your stop down here, so they got you out down here. But look what you were long for. This. So that's okay, they stopped you out. But by going with the trend of the market, you have a much, much, much better chance of success in your trades. As Gab was talking earlier about he would not take that short trade, but he would take the retest trade. That's a success because what happened was he saw in sugar, and I saw it as well too, and I didn't bring that chart, he saw the supply come into the market. Once he saw supply come into an uptrending market, the game was over. Then a weak retest allows you to sell that market short. Yes?
Can you advise counter trend trading if you see support? You're saying going?
Yes and no. Okay? Yes, I will. He has to know if you could do a counter, if it's proper to do a counter trend trade, like in a spring and a downtrend. Yes and no. In theory, in theory most likely, you should really make most of your trades on the long side of an uptrend. wycoff did allow counter trend trading, as you suggested, but let's suppose you're buying a spring on a 5-minute chart. It will give a reaction, right? It's in a downtrend, correct? The market rallies. How much cause have you built to sustain that rally? You have no accumulation. You're in a downtrend. So the spring will give you that corrective rally, maybe. But what's going to happen in the downtrend in the spring? It's going to fail. So your answer is yes. To a new trader, I would say don't do it. Go with the trend. Go with your channel lines, overbought, oversold. Use your point figure. But the most money is lost two ways. Going against the trend and trying to trade the trading range, unless you're a more sophisticated trader, that you can identify things in pattern-wise. And we'll go over where to look for trades tomorrow. But with shortness of time, I had to shorten a lot of things up today because it's a very long day. But if I could tell you one thing what to do in trading, as far as my opinion, is to go with the trend. If you get a retest and it's bearish and an uptrend, then fine. And I want to thank VSA and Gavin for allowing me to come and to try to teach. I love this with a passion. I've done it for 28 years. I do it every day, basically 20 hours a day. Okay, I do it with a passion. And it's something that I love to do. And I have all the utmost respect for people that are here today and they're here on the webcast today, because this is not easy. And wycoff, most people, 90% of you probably won't even look at it next week. Okay, but I would tell you, price and volume, in my opinion, is the only indicator that's real time, and it's proven to be successful. He had one of the most successful newsletters in his day. It will be today, tomorrow, and it will be forever. And it's the only real indicator that you see that happens in front of your eyes. And I'd rather something that's live in front of me than anything else. Okay, I want to thank you for your time, and I want to thank you. And if you have any questions, I'll be happy to. Okay, I appreciate it. I thank Gavin. I think that, I tell you, I try to get his product where he got it. So, it's worth something.
Give him a round of applause.
Thank you.
Good job. Excellent. Excellent.